Hi everyone, it's Alex Sparks here from Sparks Finance and I'm your local mortgage broker in Bathurst. Today's video is can you refinance a fixed rate? Now you may ask, well, why would I do such a thing? Interest rates are currently on the increase. I've fixed my rate at something lower. Now it's estimated in the economy at the moment that almost 38% of all the different loans are actually on a fixed rate, and a majority of those are coming off their fixed rate period in 2023. Now, people are getting quite nervous because they may have fixed their rate in a couple of years ago at, low 1.9%, 2%. And what they're gonna do is that when they come off their fixed rate period, they're gonna be ballooning out to say 5% or 5 whatever percent. And it's gonna be a massive hit for a lot of different households because they'll be going from such a small repayment up to a big one. So the reason why we're looking and having this conversation is it might be beneficial for people to break their fixed rate now and get into a new loan before they actually need to, before their fixed terms out. One reason why we would want to do this is the higher the interest rates continue to go, the lower people's borrowing capacities are getting. If you're really close, say for example your loan's 500,000 and your borrowing capacity at the moment sitting around 520, 530 or something like that, and your finance fixed rate term is coming off in July, if the interest rates continue to climb, you won't actually have enough borrowing capacity to refinance, so therefore you'll be stuck at the rate at whatever their basic variable rate is when you come off that fixed rate. So that might balloon out to something like 5.5 or 6 even, whatever that might be, you'll be stuck at that rate because you can't actually refinance, and your fingers crossed that the bank can negotiate with you to get you to something lower, which is absolutely no guarantee at the moment. What we're looking at doing is we're gonna have a look at your options and sort of say, well, if your borrowing capacity is quite close, you might make the decision now to refinance into something a lot lower than what you could be when you come out. So you may refinance to something at say 4.75 or 5% now to make sure that you're at the bottom of the market, so your borrowing capacity doesn't allow you not to refinance. It's an interesting conversation, but it's definitely something we're gonna have to have. Another way people might look at this and go, well, my situation is changing in July again. We may be looking to drop to one income later on, or I'm looking at changing job in the future and want to get on the best rate you possibly can now because you know that when you come out in July, you might not be in a position to refinance once again. So understanding this and getting ahead of this really early is such an important thing. It might be counterintuitive because you're like, well, why would I leave my 2% rate? Well, the cost of that over 3 or 4 or 5 months might be so small compared to if you stayed with it, the amount of extra interest that you will have to pay because your rate's so large and your repayments are a lot higher than what they were. So once again, it's so important to have that conversation early with a finance expert to have a look at your different options and try to get you into something sooner rather than later. Now we may say to you, great, well no, actually stay where you are. You've got so much room to move. Let's stretch this fixed rate out for the longest period you can. Or we might say, look, to be honest, might be something you want to consider doing now so we can get you in, lock you into a rate if you want to go fixed again at something lower than what you would be if you were just coming out of a fixed rate and going to this whatever bank standard variable rate is. The next question people say, well, don't I have breakout fees? With breakout fees, if you're on a fixed rate, sometimes you may have breakout fees associated with your home loan. However, when the interest rates are increasing, the bank will shake your hand and say, thank you so much for refinancing, no fees attached, thank you so much, because they're gonna make so much more money by you actually breaking out your fixed rate. So there's not gonna be any breakout fees for you. So the bank is saying, well, your money, your home loan is locked in at 2% now. If you break, we're over the moon because then we can go and give that to someone else at 5%. So they're making a hell of a lot of money, so there's no questions around breakout fees. So once again, it's just making sure that we're understanding what we're trying to achieve and understanding the pros and cons. But a lot of people are like, oh, I've got to pay breakout fees. Well, no, you actually don't, because the bank is going to make a hell of a lot more money than you sitting on that interest rate for the next however long. So once again, guys, this is a very probably unconventional way to look at fixed rates and looking into 2023. But with borrowing capacities reducing to such a point with the large amount of interest rate increases that we've had, it's so important that we get on the front foot early and make sure that you're in a position that when that fixed rate comes out, you can look to refinance or be in a position of strength to renegotiate with the current bank that you're at. or we need to really look and see to make sure that we're making the correct decisions now to set you up for the future. So if you want to review your home loan and review your fixed rate that's coming out in 2023, please don't hesitate to give me a call. We can run some numbers, have a look at your different needs and goals, and hopefully make you a decision to set you up for the next year. I hope that was good information for everyone. And if you want to discuss it, please don't hesitate to give me a call. Thank you.